Imagine a family-owned specialty coffee roaster in downtown Miami. The lease? A historic Art Deco storefront on Biscayne Boulevard. For years, that business not only paid base rent, but also an extra layer of cost, a tax on the very roof over their heads. Across Florida, tens of thousands of companies quietly carried this burden, tiny in isolation, massive in total. But on October 1st this year, something changed. A long-standing tax that once tipped the scales against Florida business and commercial real estate was abolished. The roof still stands, but one weight has lifted. Today, we're telling you the story of how real estate professionals, advocate groups, and courageous business owners collaborated for more than a decade to erase what many called an unfair disadvantage, and why this matters, not just for landlords and tenants, but for homeowners, for the Florida economy, and for you as someone watching the Florida market. Because when the cost of doing business drops, the ripple touches every corner of a state's housing market, investment climate, and community future. So stay with me, because what feels like a commercial lease tax story is really about the future of Florida real estate, jobs, growth, housing demand, and whether the Sunshine State has turned a page. What will this mean for your next investment, your next home purchase, or the next wave of companies that might call Florida their base? Let's dive in. Here's what happened. As of October 1st, 2025, Florida businesses leasing commercial real property, offices, retail storefronts, warehouses, no longer must pay a statewide sales tax on that lease. This tax, often known in real estate circles as the business rent tax, BRT, had its roots in Florida law dating back to the 1960s. In the boardrooms of the Miami Realtors Commercial Board of Governors around 2010, a conversation sparked. Florida's interpretation of rent for tax purposes included not just base rent, but pass-through costs, property taxes, insurance premiums, common area maintenance charges on triple net leases. The upshot? Tenants were paying tax on these additional costs of occupancy. And more, Florida was losing business to other states. North Carolina was cited as a competitor that didn't impose such a tax. From that spark emerged a concerted advocacy campaign. The Florida Realtors Association commissioned a study and discovered that Florida was the only U.S. state with a statewide sales tax on commercial leases. Bills were filed, policy debates ensued, and incremental reductions began. Starting around 2017, the legislature began chopping away at the rate. Then, in June of 2025, the Florida legislature passed House Bill 7031, signed by Governor Ron DeSantis, that repealed the tax effective October 1, 2025. The economic impact is massive. Florida business tenants are estimated to save about $2.5 billion annually. In South Florida specifically, according to a Q2 2024 report from Lee & Associates, average office rent ran about $37.02 per square foot, meaning tenants will save roughly $1.11 per square foot from the tax repeal in some counties, and up to $2.78 per square foot when factoring prior reductions. In Brickell, where rent averages approximately $86.83 per square foot, the two-year phase-out delivers about $4.78 per square foot in savings. In short, what began as a technical tax nuance in a Miami boardroom became a statewide economic story. From October 1st onward, commercial landlords, tenants, and investors must update lease templates accounting systems, because the tax no longer applies to occupancy beginning after September 30th, 2025. That's the backdrop. But what it means? That's where the story deepens. Let's peel back the layers. Why did this happen? And why does it matter for Florida real estate, for housing, for investors, and for you? Firstly, competitiveness. For decades, Florida carried a tax that no other U.S. state did, on commercial leasing. When a business chooses a state to lease office space, warehouse space, or a retail footprint, every incremental cost matters. A 2% tax, plus local surtaxes up to 1.5%, may look modest on a monthly invoice, but across a multi-year lease that covers 50,000 square feet or a large warehouse, the cost stacks into six figures. The message to corporate decision-makers: Florida carries a hidden disadvantage. By eliminating the tax, Florida sends a signal: we're ready to compete. That has direct bearing on real estate demand. When more companies choose Florida for headquarters, regional offices, or distribution centers, you see knock-on effects. More employment, more households relocating, more demand for housing, both rental and ownership. For real estate investors watching Florida markets, that's meaningful. But it's not just about new inbound companies. It's about reinvestment. The $2.5 billion annual savings isn't imaginary. It's real capital that businesses can redirect into hiring, into expansion, into better wages, into equipment. That means stronger local economies. Stronger local economies mean more vitality in neighborhoods, more demand for home ownership, and more resilience in real estate valuations. That trickles into the broader housing market. For multifamily or mixed-use property owners, the story is twofold. On one hand, commercial tenants may have greater financial flexibility and possibly more stable occupancy, improving building cash flow. On the other, competitive pressures may shift. Landlords may view the tax removal as relief, but savvy tenants may negotiate this saving directly into their deal as an effective rent reduction. A property owner who doesn't adjust could see the savings flow through to the tenant rather than lift their margins. Real estate professionals must be aware of that dynamic. Another dimension, the phase-out and transitional rules. Rent or license fees for occupancy periods through September 30th, 2025 remain taxable, even if paid later. That means lease accountants and auditors face complexity. Mixed-period leases, overlapping rent payments, pass-through charges may still attract tax. For those investing in Florida, commercial real estate, or structuring property acquisitions, this transitional nuance is critical. Overlooking it could create liability or missed saving opportunities. For example, if a tenant prepays January-March rent in September 2025 for occupancy starting October, no tax should apply. But if the period begins September, tax still does. Now, what does this mean for housing and the Florida residential market? While the tax directly addresses commercial real estate, the indirect effects matter. More job creation means more demand for housing. Investors often look for signs of economic momentum, companies expanding, new design centers opening, relocations, in deciding where to deploy capital. Florida just removed a structural barrier to business growth. Consider this. When companies expand in Florida, employees move. They rent apartments, buy homes, and drive absorption. When commercial landlords have lower tax burdens, that may improve NOI, net operating income, and encourage more investment in buildings, including mixed-use or properties with integrated residential components. That can mean enhanced amenities, more construction, more new supply, but balanced by demand. From a housing affordability angle, it's a double edge. On one side, the tax removal can indirectly boost housing demand, which may increase pricing pressure in hot markets. On the other hand, healthier job growth and business investment can help stabilize neighborhoods and support moderate-income households which might otherwise struggle in more volatile markets. For investors and homeowners, that's meaningful context. Also, from an investment timing perspective, if you're looking at Florida today, this change is a structural tailwind beyond just typical market cycles. We often speak of interest rate cycles, condominium supply, hurricane risk, insurance cost. Those are part of the story. But this is a governance and tax policy shift that improves Florida's investment case. If you buy an office-to-residential conversion or a mixed-use retail/residential asset, you now know the local business environment removed a friction point. However, no change is purely upside. The state loses revenue, bodily, tens or hundreds of millions annually. Some of that may eventually shift to other taxes, user fees, or altered budget priorities. If you're investing, you have to ask, will the lost business rent tax revenue lead to higher property tax rates or new local assessments in the future? Will government services change? These are questions worth asking in due diligence. For landlords, there is a negotiation risk. Some landlords may try to hold base rent constant, arguing, hey, tax is gone, but the market still requires this rent level. Tenants may push, we should benefit. So contracts signed after October 1st must be watched. Lease templates updated. Placeholders for business rent tax removed or modified. The earlier the lease is executed, the more leverage the tenant may have. Finally, for residential brokers and homeowners, although this change is commercial real estate focused, you benefit indirectly as a local market actor. Because healthy commercial investment means healthier neighborhoods, stronger employment, better wage growth, and that tends to lift residential demand or at least stabilize it. If you're a homeowner or an aspiring buyer in Florida, this is a positive signal. If you're a real estate investor, it's a macro factor, amplifying your evaluation of Florida as a target state. In short, the repeal of the business rent tax is not just a tax story, it's an economic story. It's a real estate momentum story, it's a housing market story, and it's a signal that policy can shift the trajectory of a state's investment landscape. Let's widen the lens. Because the story of Florida's tax repeal meshes with broader themes in U.S. housing, real estate investment, and regional migration. First, state-by-state competition. In the U.S., states compete for business relocation, expansion, and headquarters. Tax policy is part of that competition. Florida's removal of the commercial lease tax means it aligns more closely with states that have no such burden. In that sense, this makes Florida more business-friendly. In recent years, we've seen companies relocating to Sunbelt states, citing lower cost, favorable tax climates, and workforce availability. Florida is now better poised for that next wave. Second, historical comparisons. Think back to the 2008 housing crash. One of the factors that magnified risk was that states and metro areas had overleveraged themselves with tax burdens, property value fragility, and weaker economic underpinnings. In contrast, a strong economy with business investment and job growth helps insulate real estate markets from shocks. By improving business fundamentals, Florida isn't eliminating risk, but it's improving its buffer. Third, mortgage rate trends. As we know, home buyers and investors in Florida are sensitive to financing cost. While mortgage rates are driven nationally, local real estate value is heavily influenced by employment, demographic flows, and supply-demand dynamics. With more business growth, there may be accelerated demand for housing, tightening inventory, and less downward pressure on pricing if the economy remains lively. That's particularly meaningful for markets like South Florida, Tampa, Orlando. Fourth, insurance and disaster risk. Florida has had its share of natural disaster exposure: hurricanes, flooding, rising sea levels. Insurance markets have been under stress. Real estate professionals often worry, what good is tax reform if a major hurricane wipes out value? The tax reform doesn't solve the insurance or climate risk, but it does improve one part of the equation: economic fundamentals. Better business base plus investment equals more resilient communities equals better ability to absorb shocks. Upload that into your narrative if you're working a Florida housing story. Fifth, other cities in the U.S. and how this compares. Many markets are experiencing corporate relocations: Austin, Phoenix, Nashville, but often the stumbling block is commercial real estate cost, zoning constraints, taxation. Florida just removed one of its stumbling blocks. So if a company looked at Florida versus, say, North Carolina a few years ago and balked because of the lease tax, that objection is gone. That means Florida is now more directly comparable, if not superior in some cases. That may influence how capital flows into Florida real estate. Sixth, investor perception and timing. Investors often talk about arbitrage windows, when new policy change creates opportunity before the market fully prices it in. The repeal effective October 1st allows savvy investors to anticipate, maybe acquire commercial properties or conversion assets now. Voila, the business cost burden drops. Or residential investors evaluate submarkets that benefit from increased local employment. That's what we call front-run the policy. Many homeowners or brokers don't see that. You should. Seventh, what this doesn't cover. It's key to note, the repeal applies to commercial leases of real property, but not to everything. Short-term residential rentals, 6 months or less, parking, storage of vehicles, boats, aircraft hangars remain taxable. That means the benefit is selective, and market actors need to know their category. A business renting a car storage facility still may pay tax. An individual renting a residence for under 6 months doesn't benefit. In mixed-use deals, that distinction matters. Eighth, the trickle into residential real estate. When a business leases a large office in Brickell and suddenly their cost drops by approximately $4.78 per square foot, as per the example, they may hire more staff, expand operations, or invest in amenities. That means more employees in the city, more mid-level salaried folks seeking rental housing or first homes. That increases effective demand in the surrounding neighborhoods, condos, apartments, houses. That may lift value or reduce downside risk. Real estate professionals must connect these dots in their narratives. Finally, the human side. Behind every lease is a business owner, a tenant, an employee. For the entrepreneur renting the storefront cafe on South Beach, that tax may have been the difference between hiring another barista or holding off. For the landlord who's been burdened by tax collection compliance, it may mean less administrative overhead, fewer penalties, more time focusing on property rather than paperwork. Those micro stories aggregate into macro change. Real estate isn't just about dollars per square foot. It's about lives, communities, and future possibilities. And that human dimension often makes the difference between a tax change and a turning point. If you're working in Florida real estate, you must integrate this policy change into your strategy. What submarkets will benefit fastest? Which cities in Florida have corporate offices poised to expand? Which neighborhoods have latent demand from incoming employees? Which properties are underpriced because their neighborhood lacked this business tailwind before? Asking these questions gives you advantage. Imagine you're looking at a property in Tampa's Channel District. A tech firm chooses Tampa over Florida's rival states because the cost of office lease drops now. That firm opens an R&D wing. Employees relocate, they buy houses in Seminole Heights, they rent apartments in Ybor City, the ripple moves. As a real estate professional, you're not selling the office lease. You're selling the neighborhood, infrastructure, and the narrative of opportunity. The tax repeal is part of that narrative. On the flip side, keep your defensive lens on. Policy change doesn't erase risk. A hurricane season, rising insurance costs, interest rate shocks, they still matter. This repeal is an accelerant, not a silver bullet. Your clients, buyers, investors, homeowners still need comprehensive risk analysis. But now you have one fewer structural obstacle in Florida's favor. And when you narrative that to clients, Florida just removed this cost, so here's what it means for you. You gain differentiation. In summary, the story of the business rent tax repeal touches commercial leasing, but the real leverage for your Florida real estate channel is how it intersects housing, investment, jobs, migration, and property market structure. Use that narrative to connect with your audience, homeowners, investors, aspiring buyers, and show them you're seeing the bigger picture. So what does this all mean? For you, for the Florida real estate landscape, for the dream of home ownership or property investment in the Sunshine State? It means Florida has taken a bold step. A tax that once quietly weighed on commercial leases across office towers, retail storefronts, and industrial warehouses has been lifted. The result? Dollars freed up, cost burdens lowered, and the state's competitiveness improved. If you're a real estate investor looking at Florida, this is a structural tailwind. If you're a homeowner in Miami, Tampa, or elsewhere, this is a sign that the business foundation of your local community just got stronger. If you're a real estate professional, this is a story you can't ignore. It's not just about residential comps or mortgage rates. It's about policy, about jobs, about migration, about demand. Ask yourself, in a world where businesses might now choose Florida over another state because of this cost advantage, which neighborhoods will gain first? Which towns will see job growth ripple into housing growth? Which city will surprise you next? Because in the end, the Sunshine State is becoming slightly easier to bet on. And for you, whether you're selling homes, scouting investment properties, or teaching clients, this is the kind of story that elevates you from just listing to market strategist. What will you do with this moment? Will you flag it to your next buyer? Will you preview neighborhoods primed for growth? Will you leverage the savings story to attract investor clients? The roof still stands. The Florida sun still rises. And now, one unnecessary cost has been removed from beneath it. Thank you for watching. The story of Florida real estate just got a fresh chapter, and together we'll keep writing it.